Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lankan Airlines Limited and the government of Sri Lanka have successfully completed a major bond restructuring exercise linked to $175 million in guaranteed bonds. The restructuring relates to bonds that were due in June 2024 and carried a government guarantee. According to the official statement, the airline launched the offer in February 2026, inviting bondholders to exchange their holdings for a combination of cash and new US dollar-denominated 4% amortizing bonds due in 2028, issued by the government. The move followed an agreement in principle reached in November 2025 with a group of bondholders representing around 55% of the outstanding bonds. The transaction recorded a participation rate exceeding 99%, with more than 97% of bondholders voting in favor. As a result, all existing bonds are expected to be tendered and exchanged on the settlement date. Sri Lankan Airlines chairman Sarath Ganegoda stated that the strong participation reflects confidence among bondholders, while also noting that the transaction includes a 16% reduction on the outstanding claim. He further indicated that the successful restructuring marks an important step in the airline's financial recovery and enables a stronger focus on future growth. Secretary to the Treasury stated that the development helps normalize Sri Lanka's engagement with external partners. He also noted that restructuring agreements covering 99% of the country's public external debt have now been finalized, strengthening Sri Lanka's position in improving its credit rating. The settlement of the exchange and tender offer is expected to take place on March 20, 2026, subject to the completion of standard conditions. Sri Lanka's economy recorded a 5% growth in 2025, reflecting a notable expansion in overall economic performance. According to the National Accounts Estimates report released by the Department of Census and Statistics, Sri Lanka, the country's gross domestic product at constant price increased to over 13.1 trillion rupees in 2025, up from 12.5 trillion rupees in 2024. At current prices, GDP rose to 32.7 trillion rupees, marking an 8.8% increase. The report indicates that all three major sectors of the economy, industry, services, and agriculture, contributed positively to growth during the year. Industry activities expanded by 7.8%, while services and agriculture recorded growth of 3.3%. In addition, taxes less subsidies on products contributed 11.6% to overall GDP growth. Economic growth was supported by several key factors. These include the lifting of vehicle import restrictions and improved public expectations about economic conditions. Growth was also driven by strong performances in financial services, insurance, and wholesale and retail trade, including motor vehicle-related activities. The report notes that the overall economic environment remained supportive during 2025. This included relatively stable exchange rates, declining interest rates, and moderate inflation conditions. The industrial sector saw a strong contribution from construction, mining, and manufacturing activities. Meanwhile, services growth was supported by financial services, insurance, information technology, and tourism-related sectors. In the fourth quarter of 2025, the economy grew by 4.8%. During the period, industrial activities expanded by 7.3%, while agriculture and services recorded growth of 2.1% and 3.1% respectively. According to the department, improved economic conditions and increased activity in trade and financial services played a key role in sustaining the country's growth momentum throughout the year. Fitch ratings indicate that Sri Lanka's sovereign credit rating is unlikely to face severe downside pressure from the ongoing global energy shock linked to the Middle East conflict. However, the agency notes that the situation could slow recent improvements in the country's credit metrics. Fitch Senior Director APAC Sovereign Ratings Jeremy Zook states that while Sri Lanka remains vulnerable to rising energy prices, the impact is more likely to weaken positive trends rather than trigger a major downgrade. He also notes that the extent of the impact will depend on how long the energy price shock persists. Fitch highlights that Sri Lanka is currently in a strong position compared to the 2022 crisis period, following policy measures focused on macroeconomic adjustment and stability. The country has recorded improvements in key indicators, including a current account surplus in the most recent period, compared to a significant deficit during the crisis. However, higher oil prices are expected to exert pressure on the external sector. The impact is likely to be felt through trade, remittances, and tourism. Higher fuel costs could widen the trade deficit, while economic disruptions in Gulf states may affect remittance inflows. Tourism flows may also face challenges due to global uncertainties. Despite these risks, Fitch note that stronger current account position provides a buffer against downside pressures. On the fiscal front, policy flexibility remains limited under the International Monetary Fund's supported program. Fitch indicates that any prolonged energy shock could require further discussions with the International Monetary Fund regarding policy flexibility. While a significant deterioration in physical conditions is not expected, the agency notes that the shock could limit near-term improvements. It also highlights that recent flood-related impacts have added pressure on both fiscal and external balances. Fitch further states that improvements in foreign exchange reserves and overall economic buffer provide additional support to Sri Lanka's credit profile. In its previous assessment, Fitch upgraded Sri Lanka's sovereign rating from restricted default to CCC Plus in December 2024 and affirmed the rating in October 2025. The agency also notes that while the government remains committed to reducing debt levels, high public debt continues to be a key structural weakness. Sri Lanka's key industries are facing mounting pressures as the ongoing Middle East crisis begins to disrupt tourism, exports, and supply chains, according to business leaders. The tourism sector has been among the hardest hit. The Hotels Association of Sri Lanka President and Siddhalepa Group Chairman Managing Director Asoka Hettigoda stated that Sri Lanka is losing between 80 to 100 million US dollars per month due to cancellations linked to the crisis. He noted that the impact comes during a critical earning period when nearly 60% of annual tourism revenue is typically generated. He further explained that although daily arrivals continue, the segment is shifting towards lower spending tourists, leading to a significant drop in overall revenue. Asoka Hettigoda also indicated that forward bookings remain weak, with rising travel costs and uncertainty discouraging long-haul travel, while concerns over fuel availability and mobility continue to affect traveler confidence. Meanwhile, the apparel sector is beginning to feel the pressure. Brandex Group Managing Director Hasita Premaratna stated that although current orders remain stable, cost increases are expected in the coming months if conditions persist. He explained that petroleum-based raw materials, including synthetic fabrics, dyes, and chemicals, are becoming more expensive. He added that rising fuel, electricity, and freight costs are likely to increase overall production expenses. Hasita Premaratna also warned that prolonged instability could weaken demand in key export markets such as the United States and Europe. The tea sector is experiencing immediate disruptions, particularly due to its strong exposure to Middle Eastern markets. Tea Exporters Association member and Stassen Exports Limited Chief Executive Officer Niraj Dimel stated that shipments to several countries have been halted while some cargo has been redirected due to logistical challenges. He noted that disruptions in major trade routes and increased shipping costs, including insurance and surcharges, are placing pressure on export prices. He added that although tea auction prices initially declined, they have stabilized due to demand from alternative markets. However, he cautioned that prolonged disruptions could create storage challenges and impact smallholders. The rubber manufacturing sector is also under strain. DSI Samson Group Chairman Dr. Kulathunga Rajapaksha also stated that the industry is facing a sharp rise in input costs as over 90% of raw materials are imported and largely petroleum-based. He further explained that supply chain disruptions have delayed shipments and increased freight and insurance costs. While existing inventories provide short-term relief, he warned a potential shortage in the coming weeks, which could disrupt production. Dr. Kulathunga Rajapaksha also highlighted operational challenges. noting that fuel shortages affecting work transport and continuous production process increase in the risk of serious constraints if the situation persists. Overall, business leaders emphasize that the impact of the Middle East crisis is spreading across multiple sectors through the high energy costs, logistical disruptions, and demand uncertainty. They caution that the full extent of the economic impact will depend on how long the crisis continues. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.61%, the 182 T-bill rate stands at 7.91%, and the 1-year T-bill rate stands at 8.23%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.